Now let's dive into liquidity concepts. Liquidity is what's ultimately going to drive the market. So the first question we should ask ourselves is, what is liquidity? Market liquidity is how easy it is to turn an asset or security into cash without changing its price in the market. This concept is what makes currency trading simple and instantaneous. There's always someone on the other end of your order. In the most basic sense, there are orders at virtually every price level you see on the chart, especially above highs and below lows. These areas of liquidity are frequently targeted to fuel price movements and ensure that orders can be exchanged without issue. The direction of liquidity can be referred to as buy or sell side liquidity. Buy side liquidity simply refers to liquidity that rests above a particular level, and sell side liquidity refers to liquidity that rests below a particular level. There are two types of liquidity to be aware of in the market: internal range liquidity and external range liquidity. We categorize them this way so that you don't get lost in the fact that liquidity is present everywhere in the market. And for that reason, context is key, and this is why we delineate between the two. So let's talk about internal range liquidity first. Internal range liquidity is a term used to describe the liquidity that exists within structural price ranges. The internal range liquidity is all of the minor highs and lows and previous demand and supply levels found within the impulsive structural ranges. Limit and stop orders are often under lows and demand zones or above highs and supply zones. As a result, this internal range liquidity is often targeted when price is pulling back. The liquidity that is present within a structural range is often characterized by the ability of buyers and sellers to easily enter and exit positions within the range, leading to a high degree of trading volume. This is what makes internal range liquidity a great area to take partial profits, adjust your stop loss, or use as targets to close trades. An entry at the highs or lows of a structural range, especially if you're pro-trend, should give you confidence to hold through the reactions. Once 1 to 2 supply zones fail in a bullish reversal, there's a high probability that the rest will fail within that leg. Once 1 to 2 demand zones fail in a bearish reversal, there's a high probability that the rest will fall in that leg. So let's take a look at an example of internal range liquidity in a bullish market sense. So we can see that's denoted by the green or teal colored line. That would be our 4-hour market structure, and the 15-minute would be denoted using the black lines. And what we can see, the 4-hour structure is bullish in nature. We're seeing higher highs and higher lows. So the expectation is that we'll continue moving to the upsides, and by that, demand is also in control. So if we look at the 4-hour, we can see that the impulsive phase would be denoted in this leg, and the pullback phase would be denoted in this leg here. So internal range liquidity is targeted and used as liquidity to facilitate this pullback into demand before price continues higher, making the higher high. As price impulses upwards to form that new higher high, it's also using the newly created internal range liquidity pieces to fuel its move. So if we just take a step back, and we see that price has now created its higher high in the market. And if we look at all of the structure on the, say, the 15-minute within side of that impulsive leg, we can see that we have previous internal lows as well as previous levels of demand. And what we can see as price trades down, we can react off of demand and create the initial reaction, the extreme of the reaction leg, and the failure, which creates a supply zone. We break below the previous internal low here, and we continue doing that where we react off of demand levels, creating supply levels, and break previous internal lows until we trade down into this level of 4-hour demand. And because the market is bullish and we're expecting that this high is likely to be broken and that we are going to create a new higher high, price reacts off of demand and we continue higher. Now, if we look at the pullback leg and start to see all these newly formed supply levels and internal highs within its leg, we can also view these as internal range liquidity. These, in essence, are going to be points that the market is going to target to fuel this move upwards. And as we said, once 1 to 2 supply zones fail in a bullish reversal, the probability of the remainder failing in that leg is incredibly high, and that we can expect that the previous high is going to fail. Now, if we look at the inverse situation of supply or a bearish market structure scenario, we can see that we're creating a lower low, a lower low, lower high. The expectation is that we'll break this previous lower low, forming a new lower low. We're going to keep our eye on a 4-hour level of supply. So the impulsive phase takes place, takes shape, forms our lower low, and price begins that pullback phase. And as we can see, if we look at all of the internal range liquidity within that impulsive leg, we can see that we have internal highs on the 15-minute, as well as supply zones that are within those internal highs. And as price enters that pullback phase, we interact with supply zones to get the initial reaction, the extreme of the reaction leg, the failure of that zone that also breaks the previous internal high forms a demand zone, and this continues until we revisit 4-hour supply. Once we tap into supply, we can start to look at the internal range liquidity that was created in that pullback leg, and we can use that as targets or fuel to facilitate this move to the downside to form the new lower low. And as described, once 1 to 2 demand zones fail in a bearish reversal, there is a higher probability the rest will fail inside that leg. So now that we've discussed internal range liquidity, we're going to take a quick segue in classifying catalysts for pullbacks. They're an important concept that bridges internal range liquidity and external range liquidity. So simply put, what is a catalyst for pullback? A catalyst for pullback is another name for internal range liquidity and external range liquidity in the market. More specifically, a catalyst for pullback is an IRL/ERL, internal range liquidity, external range liquidity point that causes a reaction. When internal/external range liquidity interacts with the market, it is likely to create a pullback. As we've seen in these internal range liquidities, every time internal range liquidity is interacted with, it creates a small pullback that creates new internal range liquidity. So simply put, when price interacts with previous levels of supply or demand at previous points of internal or external structure, the market will typically create a pullback. These pullbacks are for liquidity generation to fuel future moves. They provide additional context as to why pullbacks take place in the market. And this provides further context of when we're talking about market structure and the actual pullback, we're likely reacting off of some sort of catalyst for pullback. Now let's focus on external range liquidity. External range liquidity refers to liquidity that exists outside of structural ranges of price. In its most simplistic way, external range liquidity refers back to trending market structure. Price is drawn to previous swing highs in a bull trend and previous swing lows in a bear trend. The external range liquidity is all of the key swing highs and lows. Limit and stop orders are often under key swing lows or above key swing highs. When the price is in the impulsive phase, the market will target external range liquidity. Following the trend, price may sweep a strong level of demand and continue bullish, or price may sweep a supply in a bullish price action and yield a counter trend reversal. External range liquidity above a swing high may be swept, causing a small pullback before price continues to impulse upwards, forming the true swing high. This is the same for external range liquidity below a swing low. Price may sweep the swing low and create a pullback before it continues to impulse downwards, forming the true lower low. This is also why the hard close candle confirmation is key to confirming a break of structure, as often external range liquidity will be taken, forming a pullback which can create a fake out if the proper confirmations are not used. Targeting higher time frame external range liquidity is the best course of action as you are trading to the key swing points in the market. So now let's take a look at an example of external range liquidity, very similar to internal range liquidity, and we'll have that factored on. But what we need to kind of take note of is we're in a bullish trend. We have 2 points of external range liquidity that we need to take note of, the swing high and the swing low. Now, if we're expecting that price is going to continue moving higher, we would expect that price will take the external range liquidity of the previous swing high. Now, the market could take a step further and sweep the external range liquidity below the previous swing low and still continue to trade higher. And again, this is why the hard close candle confirmation is so important. This is also why we describe in the change of character that it can be an indication that price is changing trend, but it's not a confirmation until we get that double break of structure. And it's also why when we're looking at order flow that we need to see the first level of respect hold and the last point of demand or supply fail in order to confirm an order flow shift. Because when we start to factor in external range liquidity, this is where we can start to see fake outs in the market. And if we have rules and understanding of how to classify a break of structure, how to quantify a change of character, and what actually contributes to confirming a reversal in the market, as well as confirming order flow shifts in the market, we can do a better job of not being faked out in the market. So price takes the external range liquidity below this low which is the higher low of the bullish structural range, and also trades below the demand zone before continuing upwards. And as we described in internal range liquidity and external range liquidity, or more specifically catalysts for pullbacks, which link both of these together, is that a catalyst for pullback is going to be the combination of lows in the market and demand zones, or highs in the market and supply zones. Now, the difference between the internal range and the external range liquidity is the internal is within the impulsive and pullback legs of structural ranges, whereas external range liquidity is the highs and the lows above and below the market structural ranges. The sweep of this external range liquidity is what fuels the move to the upside to create the higher high of the bullish trend, targeting the new external range liquidity of the previous high. Now, if we take that and flip it, we can see that we have a trending market where we're creating lower lows and lower highs. We're expecting that this low is to be broken and that price will break and form a new lower low. And if we look at external range liquidity, we can see that we have our swing high and our supply level. Price trades above the previous swing high and the supply zone and uses that as fuel to continue moving that price down. And as we can see, we target internal range liquidity as we feel that move to the downside to form that newer lower low. So price takes the external range liquidity above the swing high, which is the lower high of the previous structural range, and also trades above this supply zone before continuing downwards. This sweep of external range liquidity is what fuels the move to the downside, creating the new lower low of the bearish trend.